Hey, welcome back to my channel, and today we're going to talk about how I lost $6 million in the stock market.
$6 million?
With an M.
Wow.
Yeah.
You look
Not that funny.
That's incredible. Like when I was told you lost a lot of money in the stock market, I never even thought it crossed the million mark, let alone $6 million.
Yeah.
So when was this?
So that was in 2001 when the dot-com crash. So
The classic dot-com crash.
yeah. A lot of people don't, they think that the great financial crisis in 2008 was the thing, but the dot-com, there's other crises that happened in the economy over the years, and the dot-com crash was certainly a very big one.
Yeah, for sure. And so going back to 2001, you said, right? Yeah. Take us back to what initially got you involved in the stock market. How did you end up having positions in the stock market?
Yeah. So in those days, a lot of high-tech companies. So I was working for a high-tech company back in Canada, and starting I think in 97, something like that, 98. And one of the compensation that was part of the package was stock options.
I see. So it was given to you by a company that you worked for. You worked in one of the high-tech companies. Okay.
Exactly. And this high-tech company was great. It was doing very well. It was growing rapidly, and basically, so that was, I got like a certain number of stock options, and these stock options, they vest over a 5-year period. So that means that if I get like 5,000 stock options, that means that every year I owned 1,000 of these stock options that I can then exercise.
Okay, so for people who are newer to the stock market and to investing, can you explain what specifically that means? So what vesting means?
Yeah. So the stock option, maybe we can start with what a stock option is.
Yeah, let's start with what a stock option is.
So part of the compensation package was that, if you work for my company, I'm not going to give you shares of the company, but what I'm going to give you an option to buy the stock of my company, the company you work for, at a specific price. So if the price when you started your job at the company was $50, then I would give you the opportunity to buy more stocks, 1,000 stocks, let's say, or 5,000 stocks in total, at $50.
Okay, so you get the benefit of locking in a price because you worked at the company.
Exactly, at the time you work at the company. The vesting portion of it is that, so if I have the 5,000 stock options, and then it vests over a 5-year period. So every year you you basically own the 1,000 stock options. You basically are in control of it, and then you can exercise them. The other 4,000, since you didn't vest them yet, you can't exercise them yet.
But they're still locked in.
They're still locked in at that $50 strike price.
And I'm guessing the reason they do this is for company loyalty, so you don't just get a bunch of stocks at one period of time and then walk away.
Well, exactly, yeah. So they want to make sure that they're going to retain you for a certain amount of time.
Right, so it's just a bit of an incentive to stay.
Incentive, you make sure that your goals are aligned to the goals of the company, that you're going to work hard.
You keep the interest of the company in mind when you're
Exactly.
working. Okay, so that makes sense. So you get the ability to lock in a price of the stock, but it is delivered to you in terms of the ability to exercise it is delivered on a year-by-year basis.
Exactly.
And who decides that?
And you don't have to exercise.
You could choose to not do anything.
You can choose to just not do anything.
But you're spending your own money?
No, they're just given to you. They're just awarded to you on a yearly basis.
I see. So when you lock in a stock option, you're not using your own money to lock that option.
No. So it's a gift they give you. It's kind of like a bonus.
Okay.
The bonus, instead of giving you money, I'm going to give you a piece of paper that's going to give you the option to buy the stock at a
That's really
price.
nice, but is there anyone who would reject that?
No. Nobody would reject it.
Okay, because you said you don't have to exercise it.
Well, the thing is that piece of paper, that option, you don't have to exercise it right away. So you can say, I have, and that's exactly what I've done, is that after 5 years, all these stock options were vested, but I didn't exercise them until I moved to the United States.
And so what was that decision to wait? What was that for?
Well, the reason why I moved to one of the big reasons why I moved to the United States is that I didn't want to exercise these stock options in Canada and pay 50, 60% taxes.
No, you just rather pay 50% taxes to California, right?
It was less than that. Even California with
Even
all the high taxes.
California was less than
it's
Canada.
still less than Canada, trust me.
California's high.
California is the highest in the country,
You were
but
still
it's still
saving money.
still saving money compared to...
Okay, so you're like, okay, let me not exercise this. You did some strategic tax planning, and you were like, I'm going to be relocated to the States.
This is a polite way of saying it. I did some strategic tax planning.
Hey, we're trying to keep it kosher.
I just tried to higher tax rate, lower tax rate. I'm moving there.
Right. Yes. Yeah. Exactly. Okay. And so then you relocated, same company, to California?
Yes.
Okay, so you internally relocated.
And that's why I moved to California, because the headquarters was in California.
Oh, okay. Okay, so there's a couple of reasons.
Yeah.
Not just.
Yeah.
Okay. And then so what year was year 5 of your options maturing?
So I think at that time in 2000 I was fully vested. So at the end of 2000, so maybe I started working like at 1995 or something like that. I don't remember. Or maybe the vest. I forget exactly the detail of how the vesting period. Maybe the vesting period was 3 years, something like that. So I don't know all the details, but I don't remember all the details, but I think it was something like that. So in 2000, when I was here, my stock options were fully vested. So I had control of all the stock options.
So to be clear for the audience, you didn't put $1 of your own money into the stock market, but a part of your bonus or appreciation of being with the company, you ended up having money in the stock market.
Yeah, that's right.
Okay. So now we're in 2000, everything, your stock options have vested fully. You are in California. What did you do next?
So the first thing that I did, so on paper, so when I looked at this, so again, to explain how the stock option works, is that right now my stock options, the strike price, let's say, was at $50.
Okay.
I think it was actually lower than that because it had a couple of splits. So I think my strike price was like $10 or something like that.
Should we explain what strike price is?
Well, the strike price is the price at which you can exercise the stock option. So that's $50.
Okay, so that's like the option. That's the price you've striked at.
That's the price you can, where it makes sense to sell that particular stock. So they tell you that when you exercise the stock option, let's say the stock is at the stock price on the market is at $100, and your strike price is $50. You get to buy that $100 stock at $50.
Oh, so this is what the price that you locked your option in at. That's called your strike price.
That's strike price, yeah.
Okay.
So literally, as soon as you exercise that stock options, you make the difference.
$50 basically,
$50
on each option.
Yeah.
Okay.
So if you have thousands and thousands of those, then
that's how you get to the millions.
That makes a lot of money.
Okay.
Right away.
So now, go on. So what happened then?
So my strike price was actually pretty low at the time, and the stock price was pretty high. I think it was like around $100 or $120. And
wow.
So I don't remember exactly how many stock options I had, but I went to a financial advisor and I said, well, I have all this money. I better do something with it. And I have all this paper money. How do I do that? And then so they did a big financial plan, a big binder like this thick, and
wow.
then but the summary, like when I talked to the financial advisor, he basically summarized it and said, "You've done it. You're free. You can. You've made it. You can retire tomorrow. You can do it. All you have to do is sell all your stock options and all that kind of stuff, and you're done."
Wow.
And I thought at the time that, well, I don't know, I was afraid about the taxes. I heard about, I had never filed income tax in California. I didn't have a CPA yet. And it was, so I was just kind of like, I was nervous about exercising so many stock options and then be stuck. I was afraid of like the AMT, the minimum tax. So I was afraid of all kinds of things, and so I said, okay, well, I'm just going to sell
a lot of
some
immigration
of it.
confusion.
Yeah.
Okay.
So I sold some of it, and I don't know if you want to say the amount, but it was a big check.
You said it was something around $600,000?
Yeah, $600,000, and then Lynn actually had to go.
It's only 10%.
Yeah.
Wow.
Yeah. So, and then I gave it to, I just wanted to make sure that this was working, it was real, that I didn't have to pay.
You're testing it out, take some out.
And then Lynn, actually, my wife had to go and deposit it to the bank, and then she was afraid to deposit it in the ATM, so she went to the bank teller and said, "Oh, I'm sorry, I didn't know how if I should deposit this huge check in there, or should I just show you?" So I think the lady in the there said, shut up.
Rich people problems.
That's right. So anyway, so she cashed the checks, and so that was, so I got that.
Okay, and then what did you do with that money?
So that money, actually, the idea was that we would invest it somewhere, like in real estate. So I started looking for real estate. I was talking to other real estate investors, looking for apartment buildings that would have a good returns. And there was nothing.
Like, I mean, it's California.
It's California.
Literally during the tech boom.
Yeah, nothing cash flowed. And if you cash flowed, then you had to put a lot of cash into it to make it happen. And then the cash on cash return was like 1-2%. So it didn't make any sense. And then I said, well, okay, what am I going to do with that? So now I have the money in the bank, but I can't invest it in anything. So horrible problem to have. And then so
I can't believe it. I had $6 million in the stock market, $600,000 in my bank account.
Yeah, exactly. But then it gets better. I think you're all gonna love this now, because I'm gonna. This is how good this whole thing is gonna be wiped out.
Okay, but did you end up buying your primary residence then with that money?
Well, eventually, because what happens is that I was with that money. I thought, okay, well, I'm gonna go find an apartment building. I'm gonna go and buy something.
Your intention was to invest.
Talked to a lot of people, and Lynn was involved. We were kind of looking at things, and things didn't make sense.
Right.
So we kind of left it there, and then we said, well, maybe we should just buy a house then.
Yeah.
At that point. So that's where we used some of that money to invest in a house, not invest.
But just buy your house.
Yeah, buy a house.
You got a car too?
And a car, yeah. So
okay, set the family up.
All the necessities of life.
Yeah, you set your family up.
That's right.
In a new country. I mean, it was a new country for you at the time.
Yeah.
Awesome.
And then the rest of it, basically,
you kept
in the stock market that in an account that I was able to invest directly with.
And then tell us what happened.
And then the .com crash happened. So remember how so you have a strike price, and then the stock price is over here in the stock market.
Yeah, at $100,
$120,
right? Whatever
exactly.
it was.
So you have a gain here, and this is great. But then what happens is that with the .com crash, like everything started falling down, and then the price went down, and it went very close to the strike price.
Okay.
So I was lucky that it still had a little bit of value, but a lot of the people that I was working with, they were in the negative, so they were below, which means that they just wouldn't exercise their stock options, and they were worthless. So they're called underwater, because the strike price is kind of that water line. And then, so a lot of the people I worked with, this was all gone. For me, it was pretty much all gone. I had a little bit of extra money in there, maybe a few $100,000 in stock options that I exercised, but it was really, everything was wiped out. Went from $6 million all the way to a few $100,000.
It's like a 90% drop.
Yeah. It was, and that's the problem with the strike price. If you own the stock itself, even if it goes from $100 to $50, it's still worth
the $50. But because it's just a strike price, you only own the difference.
Exactly.
So that's really important to make note of, though, because a lot of people might get that confused. They're like, well, you still own $50 of thousands of stocks.
Exactly.
That's not true, though.
That's right. No, because then it's an option to buy the stock at $50, but the stock is already at $50. So
you're only making a gain.
I don't need the option to buy it at $50. That's the market price.
I see.
Right? So it has no value.
And it could have kept going down.
Oh, yeah, it did, actually.
It did.
Yeah.
Did you stay with the company much longer after that? What happened to the company?
After that company was actually bought by Oracle.
Okay.
So then at that point I said, well, I have enough.
Did they get bought by Oracle because they went down? Or?
No, I think it's just
change in
part
direction.
of normal business.
Yeah. Okay.
Yeah.
Wow. Okay, can we get a little bit of background on what exactly caused the .com bubble and what exactly happened there?
Oh yeah, absolutely. So this was phenomenal. It was a phenomenon, I would say. It was unbelievable. there was just so much exuberance in the market, in the stock market. All the dot-com companies, all the tech companies, it didn't matter what you were doing. They were always overvalued.
Just because they had .com at the end of it?
Pretty much, yeah, because they were everything. It was a fight for eyeballs, they would say, or for customers, and they didn't care about how they acquired a customer. They didn't care that they were losing money.
So it was really just like a Wild West. It was just a free-for-all. There was no regulations at the time?
No, there was regulations. It's just that the analyst would say, oh, yeah, this is, they would look at this company and say, yeah, I know this company is losing money, but...
Because it has .com, it's going to be okay.
It has 1 million customers, so if they could sell something else or do something and stuff like that, they could potentially make a lot of money.
Wow, they were valuing a company way too much off of potential.
Oh, absolutely.
Instead of what actually was going on operationally.
Absolutely.
So that's what happened. Okay, so because of
and
the
there
fact...
was thousands of companies like that.
Oh my God. You gave me an example one time. You said even just the domain name toys.com, people were just clicking. If something had a .com, they were investing. They were investing.
Absolutely. And there was a Webvan. I don't know. There's a company in California, Foster City, and they basically had, not kidding, they had a patent for boxes for delivering food, and so we have it today, but they were a little bit ahead of their time. And Webvan was basically a company that would deliver food directly to your door. Now we have it with any grocery store now. You can or Instacart or something like that. So it was kind of like the precursor of that, but they were funded with investors that was like they had so much money, and then they put it on the stock market, and then the valuation kept going off the rails. And then, people kind of woke up a few years later and they say, wait a minute, what did I invest in again? Like, I thought they would be making money by now. It's been 3 years and they're still losing money.
Okay, so there was all this overhype about the internet and .com and domains and all of this stuff, and the hype went up for a few years.
Oh,
like it was skyrocketing for years. So people probably started to get this false sense of security that it was going to keep going.
It was about 10 years. It started in 1991. That's what it is.
Imagine a rise in the stock market like that for 10 years. The crash is going to hurt.
Yeah, absolutely. It did. Trust me.
You knew the pain.
I knew the pain.
So now how did you feel emotionally when you saw this happen in your own account?
But I want to say, just before that, I was also working in New York City at the time for some clients. And then everywhere you went, the CNBC just got started, MSNBC got started, and then it was financial news everywhere. The stock market was a professional sport, and everybody could play. Everybody thought they were professionals. You would go to any business, any clients and stuff like that. The receptionist would know the stock price of all the big names. They would have a screen with CNBC on. And showing the ticker everywhere. Everybody knew, whether they were in the financial industry or not. You go to the dentist, they would know what the stock price was. Everybody was following that.
That's a really great visual.
Because
I'm picturing it right now, like everyone being so in the know of this because it was so hot button.
Yeah, and they were investing. Like the receptionist was everybody was investing. I mean, you talk about Robin Hood and all that.
Yeah.
It was kind of like...
And it wasn't even as accessible back then.
Yeah, it was kind of like GameStop with Robin Hood. But for 10 years...
10 years.
And everybody's involved.
Imagine GameStop for 10 years, millennials.
It was kind of like that. Everybody... And you can throw a dart at the chart, and then you would have a winner. Any stock... You would wait for the IPO, the initial public offering. So the day they would go on the stock market.
Yeah, the day it would
go public. And then you would buy the stock, and it would double in a couple of months, and then you would sell it or whatever. Yeah. So everybody was doing that.
Wow.
Yeah. So
that's really hard to imagine, I think, especially for people who never lived through it, like millennials and Gen Z, to just imagine a 10-year craze, just building and building and building, because every crash that we've personally seen has been maybe over the span of a few months, not even a year, probably.
Well, we had the real estate after 2001. Then we started to see real estate real estate boom start after that.
So it's interesting. Yeah, the dip of the stock markets was the increase of the. I guess that just brings like another point of just diversification, how important that is.
Exactly.
Right.
And let's talk about that diversification. When I talk about diversification, I mean diversifying in different asset class.
Not even just in stocks itself, but in different asset classes.
That's right.
So
because
real estate.
That's right. Because when I did my, so one of the things that I did in 2000 when I arrived, I also diversified. So some of the stock options that I had, I actually sold, exercised them, and then convert them to a portfolio of stocks. So I had like a money manager, and then he managed. I think it was like
That's good.
$1 million or two. I think it was $2 million that he managed. And but the thing is that
what happened to that?
Well, the thing is that I was not diversified in other asset class. I was diversified in the stock market. And when the dot-com crash happened, the whole thing went down.
Even if things that weren't tech related, the whole economy just kind of took a dip.
That's right.
Okay, I see.
And
so
companies
you
that
just want to be
existed disappeared and all that.
You just want to be in a different industry completely.
Yeah, well at that time, yeah.
Yeah.
I definitely wanted to, like how I felt after that when the dot-com crash happened.
That is actually what I want to know. Like emotionally, how did you feel?
Well, I felt more numb, I would say. I didn't feel angry. I didn't feel anything like that. It was just like, okay, what now kind of situation. I said, there's no point. It's gone. It's gone. There's no point in doing anything. I guess I'll be working a few more years, and we're gonna kind of, what's the next step here?
So, do you think a piece of the numbness and like maybe lack of emotional connection to the money is partially because they were unrealized gains? Yeah. It never really changed your life. Like you didn't experience spending $6 million. Yeah. It was kind of fugazi, like kind of fake. And it's not fake really, but.
Yeah, exactly. I mean, this was kind of like paper profit. It was unrealized gain. It was kind of like I didn't expect this to be.
You didn't expect the rise either.
Absolutely.
As much as you didn't expect the crash.
I talked to other people in other companies like Microsoft that also had stock options, and they were telling me, "Oh, this is great, and it's great that you have stock options. You're gonna be a millionaire in a couple of years and stuff like that." And I kind of always brushed it off until it happened.
You didn't buy into it, yeah.
Yeah, and then when it happened, it felt unreal. Because I was still working the day job, and then I had all
your life didn't change. You were still going to work every day.
That's right.
Okay, I guess that kind of makes digesting a loss like that a little bit easier because it was.
Oh, does it? I don't think so.
So I think losing $6 million is pretty easy, honestly.
Easy, so much.
I don't know what you were crying about or what you cared about. I don't even know why we're making this video, to be honest.
Yeah.
So like whatever, you know.
But I think what's important is kind of like is resilience. Is that there's no point in crying.
Well, what are you going to do about it? You can't change it. And so I think you talk about this a lot, but this is probably one of those key moments where like you always talk about not letting failure stop you and not letting failure go to waste is what you always say. To at the very least have your failure have a purpose and learn from it. In your learnings, was that just diversification? Was there other things that you feel like you took away from that?
I think I wanted control. So that's the thing. It was, when you're in that market, I mean, I knew in that market that this was, a lot of the stocks were like BS. Like the valuations were crap,
you had a feeling it was inflated then.
Yeah, and the analysts, the stock market analysts, they didn't know what they were talking about, and they kept inflating the prices. So all these places, Wall Street is not what you think it is.
Yeah, they're not like a bunch of experts who know the future.
Right. Yeah,
no one knows the future.
And the analysts, they don't really know what's going on. They just kind of like, they just come up with some numbers on a spreadsheet.
It's an arbitrary number.
It's pretty arbitrary. They could be more thorough about and have like a more conservative basis, but their role is to promote the stock market.
So that if they have an incentive on where your money goes, we can't necessarily expect their predictions to be accurate in that sense, right? They have an incentive.
It was pretty obvious that day and during the few years before that they were just making up numbers so that people would go and buy buy the stock, and it was pretty obvious. It was a marketing machine, and has nothing to do with finance.
You know what I found really funny that I recently read that really blew my mind was that mutual funds, which are managed by actual people and by financialists and all these specialists and stuff, they tend to be less accurate. They claim that they're going to beat the stock market and they're going to beat the returns of the stock market in general, but they actually end up being less accurate, and they end up making less money than EFTs that are not managed at all. It's just a top selection of the entire stock market, and to me that blew my mind, that like these people who spend every day, every hour of every day, that their sole purpose is to predict what's going to do better than the stock market and to make better gains, and they still don't beat just a random basket.
Absolutely, and this is and they have access to more data than you do.
Yeah, they have access to more data,
more computing power. They have mathematicians that are studying the market, trying to predict the market, and they still don't beat the market. Every once in a while, they beat the market, a year or two.
Yeah, but it's not consistent.
But not consistent, exactly.
It's just, if I would beg to say, it's luck.
Well, absolutely.
Well, it's like, oh, we got lucky, we beat it.
Something like that.
Yeah.
And in fact, so there's another group of funds that are hedge funds that are doing, they're even more mathematical. They're even more,
they're trying to be more strategic.
More strategic and more like balancing. They're using a lot of that kind of the Black and Scholes options model to kind of like offset some of the thing and make sure that they have a consistent return. Even Warren Buffett kind of like had a bet a few years ago. I don't know if you remember that.
It's a 10-year bet.
Exactly.
Yeah.
And he bet against the hedge fund and said, hey, you know what? You're gonna go do your thing.
Yeah.
And then I'm just gonna invest my money in ETF and be
call
done with
it a day. Yeah.
And he not only wiped them out, like he was way ahead of them. In terms of returns. I don't remember exactly the returns.
Warren Buffett and a friend, right?
Yeah.
They both were like, okay, one of us is going to invest in a hedge fund, which is manually, like managed by people, manual. And all these strategies, all this stuff they put in place. And then Warren Buffett was like, I'm going to just go to an EFT, which is computerized, and it's just automatic, whatever the top 500 companies are. He was going with the S&P. And after 10 years, let's reevaluate and see who made more money. The one with all this extra effort and all these people trying to make all these predictions, or just something that's computerized. Computer won by far.
Yeah, the ETF basically won
beat
by
it.
far.
And there's less fees.
Less fees on top of that. Yeah, these guys, they charge heavy fees.
They do. They charge like 2%, whereas
Mm-hmm.
EFTs charge 0.2%.
Yeah.
Do you mean ETFs?
ETFs, yeah.
Did I see EFTs?
Yeah.
ETFs.
ETFs.
Thank you. EFTs are very different.
So this is a fallacy. If you think that you can pick stocks in the stock market and beat the stock market,
you're going to waste your time.
Year after year after year, it's not going to happen.
I mean, I think there's value in personally picking industries that you might believe in or ethically align with, but I don't think there's any use in driving yourself nuts trying to make these day trades and stuff like that.
Exactly. So my definition of diversification is very different than what Wall Street calls diversification.
Okay.
What Wall Street calls diversification is kind of like bonds, stocks, and cash.
Yep.
And then for me, it's like a different asset class. So
Okay.
some money in stocks. Stocks is good if you buy an ETF. A certain portion of that, there's good qualities in that. It appreciates tax-free. It's liquid. It's easy to sell and get your money out.
And you don't need much money to start.
And you don't need much money to start, exactly. And then another asset class that I would choose is obviously real estate. So that's the other one.
And
but
specifically, you like single-family rentals.
Exactly, single-family rentals.
But then you can also diversify within real estate. You could do apartment buildings.
Yeah.
You could do short-term rentals. You could do long-term rentals.
Yeah, self-storage.
Storage.
Commercial.
Yeah.
You name it. There's a lot of things you can do.
What other asset classes do you feel like are viable options? Do you feel like, I know some people invest in art, precious metals, NFTs and EFTs.
Yeah, so precious metal is a good one. It's pretty, it tends to kind of protect yourself against inflation. I would, it's easy. It's also pretty liquid. It's pretty easy to get your money out of there. It fluctuates quite a bit, especially when times of uncertainty. It tends to climb up because there's a flight towards this very unrisky asset.
So when people feel like they're losing confidence in, let's say, the government or the dollar, or they don't know what's happening in the economy, then they tend to go
Yes.
towards the precious
Exactly.
metals, like the old standard of money.
Yeah, exactly. Or
Okay.
a war, if there's a war, a big war.
Wars.
And stuff like that.
Okay,
So, you know.
interesting.
And
And
big uncertainty, this is where people would fly to.
it makes sense. It makes sense. And then what about art?
Art,
Sounds like there's an opinion behind that laugh.
art, I mean, you saw the art that I have around, but the art is a scam. It's an absolute scam.
I thought you were going to try to be so careful with how you phrased it, but you just, all right.
It is an absolute. Whenever you go to a store and they are unwilling to tell you the price of the thing, there's no way to figure out what the price of a particular piece of art is, and all of that. They're all hush about the art, the artist, the value, the price, and if you're asking the price, it's because you don't have enough money to buy
Wow,
this
that's
property.
so demeaning.
It is a scam. Not only that, but it's such a scam. There's scammers around the scam that are feeding the art gallery and stuff like that.
What do you mean by that?
Look, there's a lot of fakes out there.
Oh,
Lots
like
of-
counterfeits, lots of counterfeits.
Lots of counterfeits. And then people don't even know the difference. People, even experts, can't
It's true.
tell the difference between the real stuff and the fake stuff.
If
So
something
what
can
I
be
do-
counterfeit so well, then it kind of like, what value does the real one have?
Well, exactly. So that's why I buy paintings that are
Replicas?
They're replicas, but they're hand painted by someone that I basically buy fakes of artists that I like,
But they're not counterfeits.
and they're
be
not
clear.
counterfeits. They're not signed by
Yeah.
fakes signed
They're
by
just,
the artist.
they're just replicas.
They're just replicas. I
Yeah.
enjoy them
Just as much.
just as much, actually more, because some of these paintings, I mean, I would have to go to a museum in here, I would have to go to a
You have to
museum
go
in
to the
Europe in order
Louvre.
to see them. So it's just like, it doesn't make any sense. I
I
want to
see.
enjoy my art today. It's the same art that
Yeah.
they have, similar art that they have somewhere else.
So then what other industries are there? Are there any others?
No.
Wow, we're limited for options as investors.
I don't know why they're trying. It's just like real estate, ETFs, this is
And then maybe gold.
maybe gold. Gold is a funny one. I think this is
Wait,
the
what
last
other
resort.
precious metals would you say then?
Silver, but
Silver is better than gold?
Silver is not better than gold.
Silver's better than gold.
So if you look at silver, someone is controlling the silver market.
Someone. Who's controlling the silver market?
We don't
Who's
know.
this someone?
We don't know who, but what's going on right now is that for the last 20 years, it didn't matter what happened in terms of the supply and demand in the silver market.
I thought it's because it's being used for like devices and stuff
Well,
like
gold is also used for device. Palladium is also used for devices, stuff like that. But the silver market is very particular because the price of silver doesn't fluctuate normally, and it's just very weird.
I think we need to make a whole separate video about this.
Oh yeah. Well,
This is interesting.
We need to do some research and kind of like really show what's going
All
on
right,
there.
mind map.
But nobody doesn't know. Nobody knows really what's going on with the silver market. And you look at
This
you
is
listen to the
interesting.
experts, and they're saying, well, I don't know what's going on.
Wow, they even admittedly they're just like it's an anomaly.
Because how come it's not going up? And in this particular second, gold is going up like this, but silver is not going up as
Interesting.
much.
They're not tracking the same way.
Yeah, they're not tracking
okay.
the same way, and then
Okay, so precious metals in general. We won't just say gold.
Yeah,
Precious
gold.
metals.
Yeah, so
Okay.
gold is
Wow,
good.
we have 3 asset classes
Gold
to work
is not
with.
controlled, but silver is Unless you like palladium. I don't know if I'm pronouncing it right. But
Palladium?
Palladium, yeah.
Well, okay, so diversification between whatever limits we have. But it could also mean maybe investing in different countries too in terms of real estate. You could diversify that way as well.
Yeah. But this is definitely not something that you want to start right up
No,
front.
that would be a more advanced
There's
kind of.
there's a lot of ramping up that you could do
Yeah.
right here in the United States. Invest in different states, different cities, different types of real estate.
So now let's kind of bring this full circle. If you were to go back and you had the opportunity with everything you know now, and let's say you literally just got the opportunity to go back in time, what would you do differently right before the crash?
Sell. Sell now.
Fuck the taxes. Whatever happens, just sell.
Shit, it's better than
Yeah, paying even 80% in taxes.
Yep, that's exactly what.
And then you
it's
sold.
very simple.
Sell. What would you do with the money?
Well, I would invest out of state in real estate. That's what I would do. I would probably keep some money in the stock market because it's liquid and stuff like that, and I would invest
Just
in
not
ETF.
touch it. Yeah, just leave it.
There was no
yeah.
ETFs at the time, so,
Right. So just an index fund.
some kind of fund.
Yeah.
And then invest in real estate, but out of state because it didn't make sense in California.
So, I mean, you ended up doing that anyway down the road.
Yeah.
You ended up investing out of state, starting Martel Turnkey, which was one of the biggest turnkey companies, I think maybe even one of the biggest in the United States.
Mm-hmm.
You guys did over 650 real estate transactions. Mm-hmm. You ran that company, you're still running it till today. It's been around for 8 years now?
Yeah.
8 years.
Yeah.
So it sounds like you would have just done what you ended up doing sooner.
Yeah, exactly. But there was one thing that prevented me from doing out-of-state investing at the time was that the technology wasn't there. Like, the phone with the cameras, that came so much later. In 2007, I think this is when the iPhone with the camera came out.
I see. So the ability to communicate with a team, if you had one over there, was limited.
Yeah. Electronic document signing, didn't have that either. I mean, that came in 2000 and around the same time.
So I would beg to say, nothing would have maybe changed about your journey too much because it kind of happened at the natural evolution of technology and the way the world was working anyway.
Well, exactly. But I might have started a little bit earlier, maybe in 2007.
Yeah, maybe a little bit earlier. Maybe you would have had a couple more million too.
Maybe,
but
yeah.
nothing would have really changed.
Yeah, no, but the other thing too, and also Zillow too. Like this is the other thing too.
Right, because you guys at Martel Turnkey got majority of your houses from the MLS.
Yeah. But also the ability to go and look at a market and look at the data and say, hey,
go
I
on
can
Google
buy
Maps,
this.
drop your person, go look around.
Yeah, exactly.
Well,
so all of that
makes
really
sense.
made sense to go out of state at that point, unless you wanted to fly there. But
So it sounds like no regrets. You ended up doing what you wanted to anyway.
That's right. No regrets.
No regrets.
Not at all. But sell if you can hear me.
Eric,
2000 if you can hear me.
you need a time machine like Back to the Future. Oh, that's so funny.
Let me check my bank account, see if the millions of dollars are back in the bank account.
Do you believe in time travel?
No.
I do, but only in the future, not into the past.
Oh, well, that's helpless.
It is. It's useless. That's why I'm not excited about it.
Useless. That's the word I was looking for.
It's helpless. Well, it's helpless for Eric. Well, thanks, Eric, for sharing that story. It's probably really incredible for other people to be able to hear this as well, especially I know at least for my generation, I'm like, I can't comprehend that event that happened, and I also can't comprehend the magnitude that it happened to you. But hearing your reflection on it, I mean, we'll hopefully save ourselves from that same mistake or any future mistakes in terms of rises and crashes in different markets, just overall diversification, keeping it safe, stable.
Mm-hmm. Exactly. Whenever you see something in the market that's like exuberant growth.
Crypto
is the trap.
Whole another story. Another scam.
Oh my God.
Let's make a list of Eric's scams.
Let's start doing that. Crypto is the same thing, but even, other markets, whenever you see something like that, that's exuberant growth, that seems illogical.
That seems too good to be true, it usually is.
Too good to be true, then, just question it a little bit and then make the right investment decision. You can take advantage of it, but just keep an eye open.
Yeah. With maybe what is your play money instead of your living money.
Yeah, exactly. Thank you for watching. As you know, I'm making this video to help you make more money, and if you want that too, make sure you like and subscribe, and see you next time.